Good night, students, and welcome to Monday night session of performance management. As I said, this is one of a few Makeup Monday sessions which we lost during the month of May. Let me get straight into it. On Saturday, I was talking to you about decision making, and I used certain examples. Now, this is what we'll be continuing with today, starting with the handout. And it's an area which does tend to pose problems for students as far as the understanding goes, because it's not something which we would normally use in our everyday life, or even our business for that matter. Now, it's not that it should not be used, but it's just not. And I'll tell you why as we go on. And this, I think, is one of the main reasons why students may have little problems understanding, at least initially, understanding the concepts of relevant costing, because the procedures itself and the relevant costing approach, okay, is not usually employed in practice by people. Let me use an example to illustrate, and it's a little scenario. Let's assume that there's a student who's attending university, and you know, his dad has recently paid his exam fees for his exams, which should be due in, let's say, let's assume that we are in the month of February and the exams are due in June, and his dad has paid the exam fees for him to write the exams in June. Now, the exam fees are non-refundable, okay, so they've been paid upfront in February as per the instructions of the university and the requirements of the university. Now, the student then comes in the month of, say, April. Remember, the fees were paid in February for exams in June. So the student comes in April and he's telling his dad, look, Dad, I'm having second thoughts about writing these exams in June. And his father asks him, very much concerned, well, why? He said, well, I don't think I've been following my study plan, and I don't think I'll be ready for the exams in June. Now, let's assume that there is a reset for students who don't write the exams in June. Let's assume that there's a reset in the month of August. So he's telling his dad, I don't think I'll be ready in the month of June, for the month of June. So, I'll just write the exams in August. And his dad said, well, no, you can't do that. To start with, I'll have to pay additional exam fees for you to do this exam in August, since the exam fees that I paid already are non-refundable. And what is going to become of that money? It means that that money which I paid is, wasted. It will just go down the drain. And you are telling me that you're trying to decide, or maybe you've decided already, that you'd not like to write the exams in June anymore. You're thinking about writing the exams in August. So what is going to become of that money? It was quite a lot. And the son replies to his dad, well, Dad, you don't need to worry about it, because, we've been studying this thing called relevant costing. And those exam fees which you paid for me in February, really, they don't matter. So, of course, Dad gets even more upset now, even more triggered. He said, well, what do you mean they don't matter? This is hard-earned money that, I paid, and it's going to go down the drain if you decide not to write the exams in June. The son says, well, it doesn't matter. It's a non-relevant course. It's a sunk course. Now, of course, the son is perfectly correct. As far as the decision as to whether the exam should be written in June or August is concerned, the fees which have been paid are indeed, okay, fees which will amount to a sunk cost, because whether the student, call him John, whether John decides to write exams in June or whether John decides not to write the exams in June, the fees have been paid already, and it's sunk. It cannot be affected by the decision. And this is what we spoke about on Saturday. Now, just to continue this saga a little bit, of course, the fees relevant to that decision will be the fees to be paid in August. Because if John decides to write the exam, or sorry, the fees to be paid before, because if he has to write exams in August, the fees would probably have to be paid before. So the fees relevant to the new exam sitting in August, those fees would amount to a relevant cost of the decision. Because if John decides not to write the exams in June and to write the exams in August, the fees have to be paid. If John decides to write the exams in June and therefore not in August, the fees will not be paid. So it is something which would differ between the alternatives, and it is certainly a relevant cost. But as far as the fees which have been paid already, and this is how you approach it, you say to yourself, well, if John decides to write the exams in June, or if John does not decide to write the exams in June, will that have a bearing on the fees which have been paid already in February? And the answer is no. So as long as it will not be affected by the decision, it's not relevant. And this, of course, is one of the reasons why, in practice, people, and indeed students, ACCA students, may have problems in understanding the concept of relevance. Because of that simple scenario I just used, and situations like that, where we naturally tend to think historic. And, we don't think relevant cost with relevant costing in mind. We tend to think historic. That's how we were brought up to think. And you need to therefore switch your mind away from thinking historic and switch it to relevant, because what we are studying here is relevant. Pun on the word here, okay? And you need to know about it. Now, I mentioned to you on Saturday, and we'll see this discussed shortly in the handout, that for a course to be relevant, there must be certain characteristics. Firstly, it must be a future course. Secondly, it must be a cash flow. Thirdly, it must be affected by the decision. Now, all of those three, okay, must be present, not either one or the other. It must give rise to cash flows. It must be affected by the decision, and it must be a future course. And this is something that we will see as we go through. So that, in a nutshell, is what relevant costing is about. Those three characteristics must always be there. Now, the way in which we will approach this, we get into the concept of relevant costing. This handout is more or less a concept handout, the first one. And then, having looked at this, we then turn our attention to specific relevant costing decision situations which you may encounter in your exam. Notice when we looked at the syllabus on Saturday, I showed you that there is something called limiting factors, which is actually studied after the basics of relevant costing according to the syllabus, but which, as I said, we would be switching around the procedure a little bit, which, in my mind is a lot better for students in order to grasp the concepts and the principles. So this is what it's about. So let's turn our attention to this first handout, as I said, which is our concept handout. And as we go on, there are small examples which I'll be using to demonstrate the principle. Now, as I said, you've got to switch your mind away. This is really the best way I can explain it. You've got to switch your mind away from thinking historic. In other words, turn off that side of your thinking, and you've got to start thinking relevant. Okay, relevant costing concepts. Future cost which can be affected by the decision, cost which will give rise to cash flows or have cash flow implications. Although we keep using the term relevant cost, of course it does apply to revenues as well, as you will see. But let me just use a very brief example. If a company is trying to decide whether they should expand their factory, the current output and sales is 100,000 units a month. The new output and sales, if the expansion takes place, will be 20,000 units a month. The additional, that is, sorry, not the new, the additional. So the additional will be 20,000, which means the total output and sales after the expansion take place will be the existing 100 plus the 20,000, so 120,000 units. the 20,000 units, okay, would be the additional units to be sold, produced and sold if the expansion takes place. Management is trying to decide whether they ought to go ahead with the expansion. Now, in that case, all that management has to do is to consider the additional revenues and the additional costs, the incremental revenues and the incremental costs. There is no need to consider the existing revenues and existing costs as long as these will continue to in future remain the same then. So if the business is going to sell 20,000 additional units at a contribution of $10 a unit, and if there will be additional fixed costs to be incurred as a result of the expansion, not existing fixed costs, additional as a result of the expansion, then the total revenue minus the total variable cost minus the total fixed cost would be the additional cash flows to be generated. And in that example, revenues obviously would be a relevant cash flow as well. So the idea of relevance also applies to revenues, but generally we tend to see it, okay, applied to costs. And all these things will be made clear as we go on. And in order to bring out the principle of relevant costing, again, appreciating that and not taking anything for granted, appreciating that students tend to have a little issues with understanding the concept of relevance, I will be using some real life examples, hopefully, which will bring across the point. And these examples really should not be taken lightly, because although they are examples which can apply to anyone in real life, okay, and sometimes they may have a twist of humor on them, okay, but they are nevertheless very important, because the whole idea is trying to get the concept across to you by using examples which you can relate to, and then of course coming back to the topic itself. Let me just expand this a bit. Okay, so as I said, this is our concept handout. It gets into the basics of relevant costing, what it is about, and so forth. And I do have here, okay, the features of relevant costs and whatnot. And by the way, let me just tell you one time, if I go down, now there are two very important videos at the end of this handout, and you should certainly view these videos after this class before the next one. These two videos really bring out the concept of relevant costing in a way which is very easy for students to understand. I would suggest that you view the second one first. Okay, this second handout on relevant costing, you should probably view it first, followed by this, other one. Okay, I mean, after we've gone through this handout, you should be able to follow both, but at this point, this is the more basic handout. Okay, this the second one, right? So let me just write that for you. So when you look at it, you remember. Okay. Okay, so view the second video before the first. That would make it a lot easier for you to follow. Okay, good. So I hope you do take advantage of these videos, because they are quite useful, and they say one picture is worth 1,000 words, and a movie might be even worth more, because our minds can easily appreciate movies and pictures a lot better than they can appreciate words. So notice in green highlighted, any short-term decision should be approached using relevant costing principles. Relevant costs and revenues are those costs and revenues that change as a direct result of a decision taken and must be a cash flow. Notice that change. In other words, they are affected by the decision to be taken and they must also be a cash flow. Let me just write this in as well for you. Okay. Okay. Okay, costs should also be future costs. So we've got some important terms here that change as a result of a cash flow. That means affected as a result. And I'll highlight the word cash flow as well. And I'll highlight future. And these are the three main qualities. Must be affected by the decision, must give rise to cash flow implications, and must be a future cost. In other words, a cost to be incurred, in future. Relevant costing attempts to determine the objective cost of a business decision. An objective measure of the cost of a business decision is the extent of cash outflows that shall result from its implementation. Now, as I said, although the concept of relevance does apply to revenues as well, and we will see this indeed as we go on, generally we tend to use the term relevant cost, and this is what I'm showing you here. Relevant costing focuses on just that and ignores other costs that do not affect the future cash flows. The underlying principles of relevant costing are fairly simple, and you can probably relate them from to your personal experiences involving financial decisions. And that's the easiest way. Another reason why students often have problems understanding relevant costing, really it may not be their fault initially if it's being taught to them. Now, if they're self-studying this topic, it can be a nightmare because again, it's not the easiest topic. Just as with throughput accounting, this is not the easiest topic for a student to study and understand on their own. Now, if it's being taught, okay, and the student, is having issues understanding, one of the reasons for that might be because the tutor is using examples which are solely performance management type examples or textbook examples, and that might be a problem because it's like trying to walk before you creep. You've got to creep before you walk, and in order to creep, as far as we are concerned here, okay, creeping here would mean using examples that you can relate to on a more personal basis, and then walking would be the actual textbook type or exam type or syllabus type scenarios. So let's take a look at this example. For example, assume you have been talked into buying a discount card of ABC Pizza for $50. So you paid $50 for the discount card, okay? And this entitles you to a 10% discount on all future purchases. Say a pizza costs $10, so it will be $9 after the discount and 10% discount. At ABC Pizza, and it subsequently came to your knowledge though that a similar pizza is offered by XYZ Pizza, another company, for just $8. So notice you purchased a $50 discount card, okay, from ABC Pizza, and the purpose of it is to, on all future purchases, you will get 10% discount. So instead of paying $10, you'll pay $9. But then, after you made that purchase of the discount card, it came to your knowledge that a similar pizza offered by another pizza retailer for just $8. So it's similar, it probably has the same type ingredients and whatnot, $8. So the next time you would have ordered a pizza, you would have hopefully placed an order at XYZ Pizza, realizing that the $50 you have spent is already irrelevant. It's irrelevant, so it's a sunk cost, and we will see what that is below. That's the example I used before with the similar to the example I used with the exam fees, which the parent paid in the month of February. See, you know, in this case, you may be saying to yourself, well, I've wasted this $50. Well, actually, yes, you have. Nothing can be done about it, though. I mean, think about it. You certainly, I mean, this would be very silly, okay, for you to think like this. You might, if indeed you're saying, you know what, I purchased that $50 discount card from ABC Pizza, where every future pizza that I buy, instead of $10, I'll pay $9. I'm going to make sure and take advantage of my discount. So I'm going to go to ABC Pizza and I'm going to buy pizzas from there in future because I paid for a discount card and I'm going to pay the $9. Now think how silly that is. You will be a lot better off if you were to buy from XYZ Pizza and pay the $8. Because the $50 you paid is not going to change either way. But you will be receiving a savings of $1 on every future pizza which you're going to purchase from XYZ Pizza Company. Instead of paying $9 from ABC, the post-discounted price, you're going to pay $8 from XYZ, the normal price of the pizza. This is a good example. Relevant costing is just a refined application of such basic principles to business decisions. The key to relevant costing is the ability to filter what is and isn't relevant to a business decision. See, although it's really not a difficult principle to follow if you understand even a simple example like this, and if you appreciate the fact that a relevant cost must have these three qualities that we keep talking about, yet it's very difficult. Well, not very difficult, but it's a bit challenging. I'll use that term instead of difficult, for a student to just switch over to relevant course and forget about historic course, which is what they've always been taught. You know, and that I'm telling you, that is the problem. That is the main problem. Because as a student, that was my main problem. The sad part is, in my case as a student, the lecturer just went straight into the lecture, and these guys in the UK, you know, when they lecture and they do lecture, I mean, they will just talk about the thing, and if you follow and if you understand, or don't follow and don't understand, well, that's your problem. You need to figure it out. And in my case, the you know this topic, decision making, was not done in level 1 costing, it was done in level 2 management accounting. And this particular lecturer, okay, was quite an arrogant fellow, because if you attempted to ask a question, he would, you know, give you an answer, okay, which you know, made you out to be a bit silly. Yeah, he would really give you an arrogant answer, put it that way. So nobody wanted to ask any questions, therefore. Okay. But if he used simple examples like this, okay, and I was not the only one, most students were having problems. Had he used simple examples like this, students would at least be able to appreciate. And had he acknowledged the fact that prior to coming to this class and doing a relevant question, students would not think like that. Students would think historic question. So you need to, as a tutor, remove that first and get them to switch over to a relevant costing thinking process. Now, back to the handout. Relevant costs and revenues, as I said, it does apply to revenues also, have the following features. Firstly, there are future costs and revenues, as it is not possible to change what has happened in the past. Relevant costs and revenues must be future costs and revenues. Secondly, they are incremental. Relevant costs are incremental costs, and it is the increase in costs and revenues that occurs as a direct result of a decision taken that is relevant. Now, I'll use a simple example in a minute. Let's just read out the three of them. Common costs can be ignored for the purpose of decision making. In exam questions, look out for costs detailed as differential, specific, or avoidable. Now, those three terms actually are three adjectives that describe relevant cost. See, relevant cost may be sometimes referred to as differential cost, specific cost, avoidable cost, opportunity cost, incremental cost. The reason why different terms are used is because a specific term is more appropriate in a specific decision-making situation. You know, it is a relevant cost, except that it's more useful to refer to it sometimes as a avoidable course rather than a differential course. But it is the same course, you see. It is still relevant. It's like you, some people referring to you, okay, as an employee, others referring to you as a parent. You're the same person. But clearly, it makes more sense for your children to refer to you as a parent, because I mean that's something that we can understand and that your children will understand, and it makes more sense for your employer to refer to you as an employee rather than getting them all mixed up. So different terms are used to describe relevant costs, but the costs are relevant nonetheless, and the reason for using different terms is because of certain different situations, as you will see. Thirdly, there are cash flows. In addition, future costs and revenues must be cash flows, arising as a direct consequence of the decision. Relevant costs do not include items which do not involve cash flows, depreciation and notional costs, for example. Now, we will take a look at question 1 in a minute, but before that, okay, one of the things that I will go on to explain to you in this handout, you know, is how do we determine whether material costs are relevant and labor costs are relevant and overheads are relevant and so forth. But before we go to question 1, okay, this second point is quite a good one. They are incremental. Relevant costs are incremental, and it is the increase in costs and revenues that occurs as a direct result of a decision and so forth. Let me show you something. Now, this is a handout we'll be taking a look at just now. This is actually question 1. Okay, and it is possible that 1 or 2 things that you see here in question 1, okay, you may not fully understand, but that's fine, because I can assure you as we go on into this handout, we will be looking at the different examples and the different types of relevant costs. For example, how do we know whether a material cost is relevant? How do we know whether a labor cost is relevant? How do we know whether an overhead cost is relevant? So you may see the term overheads used here, and you have to figure out whether the course is relevant, but you may not fully understand. Nonetheless, you know, we'll go through it, and I'll explain as we go on. But let me use an example to show you this thing about incremental. You know, an incremental course is a relevant course. An incremental course is an additional course as a result of this of a decision. Previously, we used the example. Let me use that same example. Okay, current. The scenario is this. Okay. Right. X, Y, Z. Okay, company is trying decide whether the factory should be expanded. The expansion course will be paid in installments. Okay. Hang on a second, let me just close off something here. Actually, I don't want to close it off. There's something I need to show you on the Facebook page of Zircon Tuition, which is specifically for students. Right, so the expansion course will be paid in installments, okay, at 50, sorry, $50,000 per annum over a 10-year period. Right. The following information has been provided. Current output and sales per annum, 100,000. Current contribution per unit, okay, is $10. Now remember, contribution is sales as variable cost. Now, as we would have seen when we looked at marginal costing, variable cost is indeed considered to be a relevant cost. We mentioned that in passing, and I told you when we get later on to relevant costs, and you see the term again. The reason why variable costs are assumed to be relevant costs is because it is assumed that if a company has to make one more unit, it must incur the cost. If a company has to cut its production, it would save the cost. So variable costs are normally considered to be relevant costs. Of course, the selling price of a unit is also a future unit is also a relevant revenue, because if the company decides to sell one more unit, the additional revenue will be, received. If the company sells one less unit, the revenue would be lost. Fixed costs, on the other hand, and again, at the risk of repeating myself, this will all be explained further on the handout. The reason I'm telling you now is because I wish to use it in this example, and you'll see it on the few short examples shortly on the spreadsheet. Fixed costs, though, may or may not be relevant. See, if there are existing fixed costs, which would not change as a result of the decision, because they are fixed, then it will not be relevant to a decision. But if, on the other hand, there is a specific fixed cost, in other words, a fixed cost which will be incurred directly as a result of the decision. For example, the company needs to rent an additional factory. Then that, and rent is normally considered to be a fixed cost, that will be a relevant cost. But when looking at examples and you come across the term fixed costs absorbed and apportioned and so forth, usually that means they are not relevant because they would be incurred regardless of the decision. But again, all this will be made clear to you as we go on in the handout. Let me just write here. And by the way, if a question simply in a question, if the question just states fixed costs would be say 20,000, and the company is thinking about doing something additional, you are to normally assume that the fixed costs are not relevant. The examiner in a question must give you certain further information before you can decide whether the fixed costs are relevant. And again, you'll see this shortly on the handout. So I'll just put here, okay, current fixed costs per annum. Okay. 30,000. These costs, okay, would not be affected by any expansion decision, which is another way of saying that the fixed cost will not change then as a result of any expansion decision. Now, so this is the existing situation. This is what exists right now. Now, let me just write additional units will be 20,000. Let me clarify this from the expansion. Okay, and this is per annum. It will be 20,000 because I'm using a 1 year time frame. Additional fixed costs. Right, now you've been actually told in this question additional fixed costs as a result of the expansion. So clearly this will be relevant because although it's fixed, unlike these existing fixed costs, these existing fixed costs would not change as a result of decision. But if the business decides to go ahead with the expansion, XYZ company decides to go ahead with the expansion, there will be additional fixed costs to be incurred. This may be, for example, they will need to hire an additional supervisor or somebody who will receive a fixed salary. So it is fixed, but it is relevant. Now let's see why, in this case, the fixed cost will be relevant, the additional. Firstly, it is a future cost to be incurred as a result of the decision. Secondly, it will be affected by the decision, meaning if XYZ decides to go ahead with the expansion, they will have to pay the fixed cost. If they do not go ahead, they will not pay the fixed cost. So it will be affected by the decision. So it's a future cost which will be affected by the decision. Clearly, it's a cash flow because additional fixed costs will have to be incurred. Now, for applying those three criteria, that's why the existing fixed cost will not be relevant. Firstly, it's not a future cash flow as a result of the decision. Remember, I told you the three qualities must apply, not either A or B or C. The three of them. Cost to be relevant must be future, must be cash flow, must be affected by the decision. The existing fixed cost. Yes, the company has to incur fixed costs in future from the existing fixed cost, but whether or not the company decides to go ahead with the decision to expand, those fixed costs would still be incurred. So a student may say, but every year the student has to pay, every year the company has to pay $30,000 in fixed costs, which means next year when they've expanded, if they decide to expand, they'll pay $30,000. Agreed, it is future and it is a cash flow, but it is not affected by the decision because whether the XYZ decides to expand or not, the 30,000 existing will still be paid. And this again is why I told you the three different conditions, the three different criteria must apply. Future, affected by the decision, cash flows. Now, on the other hand, the additional fixed costs, as I just explained, will be relevant. Future, affected by the decision, cash flow. So additional fixed costs, okay, per annum will be $10,000. Now, notice this 50,000 up here. okay, would obviously be a relevant cost per annum as well, because the expansion cost is going to cost 50 will cost $50,000 per annum over a 10-year period. So I will put here expansion cost per annum 50,000. Right, and the question is this: should okay the expansion be undertaken? Okay. Now, using the information given, we will now decide whether the expansion should be undertaken. Okay. Now, it's not necessary to consider any costs or revenues which will remain the same as a result of the expansion, which means we don't need to consider the existing 100,000 units, because it is assumed that that is going to remain the same per annum regardless of whether the expansion takes place. What we do need to consider though, we need to consider the values and the figures related to the additional 20,000, because those will change as a result of the expansion. And this is important, because if you need to calculate should the expansion, or determine should the expansion take place, okay, if you need to consider whether the expansion should take place, okay, you should only consider, in fact, irrelevant costing. You should only consider the relevant cost. You know, sorry about that. I think I overdid it or underdid it. Yeah. Okay, this should be better. Right. Okay, so let's work it out. Should the expansion take place? Now I'm going to use a certain term here, or certain terms, which we actually met on the handout a few minutes back. Incremental. Remember, I told you that you would see different terms used to describe relevant costs. Incremental, avoidable, opportunity, you know, things like that. And the reason why different costs are used to describe different terms, sorry, are used to describe relevant costs is because when examining certain specific type of decisions, it's more appropriate to use certain terms. I use the example of an individual such as yourself in your office being referred to as an employee by your boss, and maybe referred to as a work colleague by your friend, you know, your co-worker. So on the one hand, you're referred to as a colleague by your co-worker, a friend. On the other hand, you're referred to as an employee by your boss, but you're the same person. On the other hand, when you get home, you'll be referred to as a parent by your children. But, you know, regardless, you are the same person. And it would not do for your child to refer to you as an employee, or your boss to refer to you as a parent. You see, so that's why the different terms are used. So should the expansion be undertaken? Now I'm going to put here incremental revenues. Or since I actually have been given the contribution per unit, I was not given a selling price. So what I can actually do is just put incremental contribution. Everyone knows anyway, although it is a term using relevant cost, and we all know what increment means. If you in your job, you've been told you're going to get an increment in your salary from next month, that means an addition to your salary. So incremental contribution, okay, I'll put here in brackets 20,000 times 10, $10, okay, because remember the contribution is $10 a unit. Okay, so that's 200,000. Now remember, this is per annum, okay? Because it will be 20,000 additional units per annum. So if the entity, if XYZ goes ahead with the expansion, they're going to generate an additional $200,000 in contribution per annum. Now that's a positive cash flow. Remember, contribution is sales as variable cost, both of which are considered to be cash flows and therefore relevant. But against that, XYZ needs to consider costs which will be incurred, which are specific to the decision. Now again, there's no need to consider the current contribution, because the current contribution is going to remain the same. That is what is being assumed. There is no need to consider the current fixed costs, because I told you we are assuming that the fixed costs at present, which may be rental costs at the factory, okay, the existing factory space, 30,000 would still have to be paid. So there is no need to consider anything which will not change. That would really just cloud up the issue and make things a bit more difficult to understand. So we are only considering things, cash flows, which are relevant. And this is exactly how you need to approach it in a question. So this is the incremental contribution, and I'll put incremental cost. Okay, now let us consider. And let's apply our three-prong test. Future cost, cash flows affected by the decision. If XYZ goes ahead with the expansion, will the $10,000 be incurred? The answer is yes. So it will be affected as a result of the decision, and obviously it's a future cost, and it is a cash flow also, 10,000. So I would put, okay, 10,000. Next, let me just put fixed cost. Right. Next, the expansion. Now clearly the expansion cost is a relevant cost, because if XYZ goes ahead with the expansion, they're going to have to incur $50,000 a year. And again, I'm using a year as a time frame for us to keep things, comparable, and indeed to achieve a certain degree of consistency. So I will put here expansion cost. Need to expand this a bit, and that is going to be 50,000. So 50,000 and 10,000, okay, would be 60,000, and I'll put here and it means therefore that the additional profit cash flows, okay, I'll call it profit, but of course it is cash flow profits, would be 140,000. And by the way, in the exam, you don't need to call it additional cash flow profits. You can simply call it additional profits, because you've only used cash flows on the way down. The reason I'm using cash flow is just to emphasize that everything is cash flow related. And therefore, and of course, don't forget, if a question like this asks you, should the expansion be undertaken? And this can be a section B type question, where you're given a little scenario, and from that scenario you've got to answer 5 questions, and this may be one of them. And if the question asks you, should the expansion be undertaken, and of course it may be, or maybe it's done in such a way that you need to state whether it should be undertaken, but of course stated in such a way that it fits into an objective test format, okay? don't forget to answer the question. Just working out the calculations, of course, are not stating the final answer, especially where it's an objective test question. The question may actually be phrased just to accommodate the MCQ format. It may be phrased in this way: which of the following represents the additional cash flows, okay, to be generated from the decision? And you may be given some negatives and some positives. So obviously it means you've got to work it out and then tick the relevant answer. But I'll just put here, therefore, the decision, okay, should be to expand, okay, the factory. So in this little example, okay, we've actually covered a few very useful, okay, points, which you will see expanded upon in the handout as we go on shortly. Firstly, we've seen that fixed costs will generally be non-relevant costs unless a question tells you otherwise, and telling you otherwise would be, for example, where the question says that the fixed costs will change. In other words, there are specific fixed costs specific to the decision. But any existing fixed cost, the existing fixed cost may be currently absorbed into the units. You know what we mean by that. If the current units total 100,000 and the existing fixed cost at $30,000, then $30,000 may be currently apportioned over 100,000 units. And the question may try to trick you by saying, well, you know, the company would apportion the fixed cost now over the existing and the new units. So what you're going to do is take the existing 30,000 and apportion it over 120,000 units, meaning it will be spread over more units. And if you don't know what you're about, you may say, okay, well, that means it is relevant to the decision. But of course, it's not, because the 30,000 in total remains the same. That's not changing. It does not matter. Clearly, the company would spread the 30,000 over more units now, because after all, it's costing. It has to spread it out. But for decision-making purposes, it's not relevant, because the same 30,000 which exists right now will remain the same after. It's simply being spread out over more units. Okay, and that's why, again, you need to hold on to those three important points about any relevant course. Must give rise to cash flow implication, must be a future course, must be affected by the decision. All three, not either A, B, or C. So the decision should be to expand. Spoke about fixed. I told you normally variable costs like direct materials, direct labor, and so forth would be relevant. But we would look at the specific rules applicable to the different costs as we go on shortly, for you to determine what is the relevant cost, because it's not as straightforward as this example. It could become a bit more complex. Okay. Now, before we go back to the handouts, let's take a look at these little scenarios here. Question 1 asks, okay, let's just temporarily, okay, move these out of the picture so we can focus on the question itself. Okay. But I don't want you to get, distracted. That's why I usually put the questions on a separate sheet. But anyway, okay. So question 1 has 4 parts to it. Identify which of the following costs are relevant to the decisions specified. Now, all of the questions ask you basically the same thing. Is the cost relevant? Is the cost relevant to the decision? And so forth. A, the salary to be paid to a market researcher who will oversee the development of a new product. This is a new post to be created, especially for the new product, but the 12,000 salary will be a fixed cost. Is the cost relevant to the decision to proceed with the development? Now, this is a fixed cost. I told you that unless told otherwise, fixed costs are assumed to be non-relevant. They will remain the same. But if the fixed cost is specifically related to the decision, in other words, if the total fixed cost will increase as a result of the decision, then it is relevant. Now, sometimes students would simply say to themselves, well, a fixed cost is not relevant. All they would have focused on is that part about fixed costs, which says it's not relevant usually. But there's a but it may be relevant if it is an additional fixed cost. And this is exactly what happens here. Although the 12,000 will be a fixed cost, meaning that a fixed cost is one that does not change regardless of changes in output, but it is a new post being created. And if the company decides to go ahead with the development, they will have to incur this additional 12. So clearly it is fixed. The second question, the 2,500 additional monthly cost of a new machine to be purchased to manufacture an established product. Since the new machine will save on labor time, the fixed overhead to be absorbed to the product will reduce by $100 a month. Are these costs relevant? Again, any additional cost will be, so the 25 definitely will be. But the fixed overhead to be absorbed by the product will come down. Now, anytime you're looking at a fixed cost and you see absorbed, apportioned, or anything like that, it's not relevant. That's like the example I used just now, a few minutes ago, where with the example we looked at, where I said the existing 30,000 is being absorbed or apportioned over the 100,000 units. But if the additional 20,000 units are to be produced and sold, the same 30,000, it remains the same in total, you understand, but it will then be apportioned over 120,000 units. But it's not relevant to the decision. It's a costing thing. It's what, the costing staff will do in their calculations in total. But for decision-making purposes, we've got to think relevant. So there'll actually be a reduction in the fixed cost per unit in the example we spoke about, the 100,000 units, because the 30,000 now being spread over 120. And that's the same thing here. So this fixed cost will not be, but the 25 clearly will be. Now, C is a tricky one. It's something that we need to look at in a while. And again, this is why those three qualities or criteria must always exist for a cost to be relevant. C says office cleaning expenses are $125 for next month. The office is cleaned by contractors, and the contract can be cancelled by giving 1 month's notice. Is this cost relevant to a decision to close the office? So the company is trying to decide whether they should close the office or not. That's the decision. And with the description given about office cleaning expenses, you've been asked, is it relevant? Now, you're thinking to yourself then, well, let me look for my three criteria. Is it a future cash flow? The answer is yes. It hasn't been paid as yet. Its cleaning expenses are $125 for next month. So it is a cash flow. Now follow me on this, because it's a pretty good example as to why the three conditions must be present for it to be relevant. One condition is relevant. It is a cash flow, because it will be incurred. It hasn't been paid as yet. But will it be affected by the decision? So it is a future cash flow, two of the conditions. But the third condition, will it be affected by the decision? In other words, then, okay, if the business decides to close down the office, will they save that $125? Will it be affected by the decision? Now, the answer is no. The reason being, because you were told the office is cleaned by contractors and the contract can be cancelled by giving 1 month's notice. What that means, therefore, okay, is that that decision, okay, to close down the office, yes, it can be taken today. But since the 125, okay, would already have been it would have been committed then, okay, for the next month, because a whole 1 month's notice has to be given, then it cannot be changed. It will not be affected as a result of the decision. It's like you, right? If you work for a company, okay, and let's assume that you paid, say, $5,000 a month, okay, and you're thinking about leaving, and you receive your salary at the end of the month, okay, and you were told as part of the agreement you need to give your employers, okay, say 40 days notice. Today is the 5th of the month. Now, if you go to your employer today and say, look, I'm planning to leave, okay, firstly, you have to work out the remaining time that you're supposed to give, notice for 40 days. Secondly, as far as the employer is concerned, the salary which you will receive at the end of this month will be received regardless, because it's 40 days notice you've got to give your employer. So they know, therefore, from their viewpoint, okay, that you can't leave until 40 days have expired, and therefore you will receive the salary. So if someone says in payroll department, oh, okay, so we're going to be saving $5,000 this month because say John or James or whoever is leaving, no, you wouldn't be saving 5,000, because that, it's like a committed cost. And committed costs, as you will see shortly, costs which haven't been incurred as yet, cash flows, but which cannot be changed as a result of the decision, because usually they're part of some past contract, they are not relevant. And this is something that we'll consider in a bit more detail shortly as we look at the different type of course. Expenses are £75 paid to the marketing manager. This was to reimburse the manager for the cost of traveling to meet a client with whom the company is currently negotiating a major contract. Is this cost relevant to the decision to continue negotiations? Now, this is not relevant. This is a non-relevant cost, because whether you decide to continue negotiations or not, the expenses of £75 have been paid to the marketing manager. In other words, say it like this: if I decide to continue negotiations, I being the management or somebody representing management, would I save the £75? The answer is no. If I decide to stop negotiations, will I save the £75? The answer is no. It was paid to the marketing manager, and this was a reimbursement for something in the past, so it's a sunk cost, as you will see. So we've got the answers here. Let me just pull them back. We're close to the questions. I'll line them up better. Right. Okay. So the salary is a relevant cost, as we said. Do not be fooled by the mention of the fact that it is a fixed cost. It is a cost that is relevant to the decision to proceed with the future development of the new product. This is an example of a directly attributable fixed cost, or in other words, sometimes referred to as a specific fixed cost. A directly attributable fixed cost may also be called, well, that there it is, a product specific fixed cost. B, the 2,500 additional running costs are relevant. The saving in overhead absorption is not relevant since we are not told that the total overhead would be altered. The saving in labor costs would be relevant, but we shall assume that this has been accounted for in determining the additional monthly running costs. You haven't been given any information about the labor costs specifically anyway. C, right, remember what I said about it being a committed, and you've got to give a 1 month's notice. So they've got to pay it anyhow. They can't just pull out suddenly. This is not a relevant cost for next month since it will be incurred even if the contract is cancelled today. If a decision is being made to close the office, this cost cannot be included as a saving to be made next month. However, it will be saved in the month after, so that it will become a relevant cost saving from month 2 onwards. You see, because that's the, it's like you having given the employer the 40 days notice. Okay, of course, after the period, okay, then you're no longer there. So clearly, in that case, the company will be saving the salary. And D, this is not a relevant cost of the decision to continue the contract. The 75 pounds is sunk, cannot be recovered even if the company does not proceed. And it's as simple as that, really. Okay, well, let's return to the concepts handout and continue a bit. So this is where we were. Question 1. We looked at both the illustration I made up as well as question 1. Okay. Now, remember I told you that relevant costs may be referred to in different ways. And here you are seeing some of the terms. Relevant costs are avoidable costs. If you are doing a question and you see the term avoidable cost, then it's a relevant cost. Now, as I've been saying repeatedly, the reason why relevant costs are given different names is because it's easier to relate to them in certain specific scenarios. What you will find is that avoidable costs usually refers to a specific decision scenario, okay, which deals with a closure decision. So if, for example, or a cessation decision, as you will see, again, a closure decision means the company is trying to decide whether they ought to close down a department or keep it open. Any costs which should be saved as a result of closing down the department are avoidable costs, and therefore they will be relevant to the decision. The company decides to close the department, they will be saved. The company decides to keep the department open, they will be incurred. But similarly, unavoidable costs will not be relevant. So if there are any costs which will be incurred regardless of the decision to close or not, then of course these costs are not relevant. They are unavoidable. Okay, they will continue to be incurred. Now, avoidable costs will always have the 3 criteria we keep talking about: affected by the decision, future, cash flows. These are costs which should be incurred if the activity to which they relate did not exist. And that activity is normally, as I said just now, a closure, a decision to close or stop making a product line. Therefore, they are relevant. And these will be considered in more detail. Each of these costs here, the only way you will fully appreciate the meaning and implication of these costs or these terms of avoidable opportunity and so forth is when we actually look at the different decision-making scenarios and see how the different costs apply to each scenario. So when I show you an example that deals with a decision to close down a department or keep it open, we would use the term avoidable. And by the way, in case you're saying to yourself, or maybe you're thinking, well, so there are an innumerable amount of decision situations. I mean, how many decision situations will I have to consider? Can the examiner just make up any old decision which, well, the answer is no. There are certain specific decision situations that you need to know of, and those are what will be covered. So any relevant costing question which you get for exam, especially if it's a section C type constructive question, will refer to certain types of decisions which we will be covering. It's just about 4 or 5 of them. Okay. An avoidable cost will relate to a closure decision. We'll come to that shortly. Now, an opportunity cost is also a relevant cost. Opportunity costs only arise when resources are scarce and have alternative uses. When an alternative course of action is given up, the financial benefits lost are known as opportunity costs. So they are the lost contribution from the best use of an alternative foregone. Now, future incremental cash flow, the three and categories of relevant costs, sometimes you may also see them referred to as incremental, avoidable, opportunity. Now, everyone, actually, although I said at the start of today's lecture that one of the reasons why relevant course may pose problems for students initially is because we've always been taught to think historic rather than relevant. I mean, that's how it is, and I use an example at the start. But opportunity cost, actually, we tend to think like that, you know. We tend to consider the opportunity cost when making decisions. You know, if for example, okay, let's say you currently have an apartment which you rent out, okay, right, and you earn $5,000 a month from renting the apartment. Okay, now follow me with this example. Someone comes along, okay, and they're willing to pay you $10,000 a month. Maybe they wish to use the apartment for some other reason, but it's not as though it's going to damage the apartment or anything. Now, clearly, okay, I'm using a very simple example here. Clearly, your increased revenue is not $10,000, it's $5,000. The reason is because you're already receiving $5,000 anyway. If you've got to rent out the apartment to this other person, you're going to get 10, which is simply an increase of 5. So that's how you need to look at it. Now, that could be useful, of course, if you're working out if there are some additional costs to be incurred if this person decides to rent the apartment. Because in that case, as how we did this in the example on the spreadsheet, you then consider the additional revenues and the additional costs. The additional revenues will only be 5, and the additional costs will be whatever. So let's assume that the additional cost comes to 6. If you were to say to yourself, oh, it doesn't matter, I'll be getting 10 anyway. Well, that's a bad decision because you're already getting a show of 5. So you can't just say, well, I'll be getting 10 and it will cost me an additional 6. That's just 4. Exactly, that's just 4. See, what you need to consider instead is this. You need to say, well, the additional revenues, which will be 5, but the additional cost, which will be 6, which means I'll be 1,000 worse off as a result of the decision. So no way. Now, in actually acknowledging the fact that there's an existing 5,000, in a way, that's a bit of opportunity costs as well. But more specifically, opportunity costs, okay, are used when a course of action, okay, in taking on an additional course of action, you have to give up something. So let's assume, and this, because it's relevant, it must contain the three qualities affected by the decision, future, and gives rise to cash flow implications. Let's consider, on the other hand, that you've got $5,000, okay, in some deposit account, and you earn an interest of say, or a return of say $500 a year on it. Okay, now we're ignoring inflation and so forth. Okay, so you got $5,000, and right now, every year you earn $500 on that 5,000, a 10% return. A friend comes to you, a very good friend of yours, okay, and he says, look, can you lend me $5,000? Now, it's a good friend, so you don't have any issue with lending him the money as long as you can afford to lend him without affecting your current lifestyle. And you're pretty much certain that he will pay you back. Okay. So you take the $5,000 out from where you've got it now, and you lend it to him, or at least you told him, you said, look, okay, not a problem, I'll lend you the $5,000. And he says, okay, good. But then you tell him, however, at the end of the year, you're going to have to pay me $5,500. So then he looks at you in dismay and exclaims, but we've known each other for so many years. Is it then that you're trying to make a profit on my head? I thought you would just lend me the money. And to which you will say, no. Lending you the money will really cost me not 5,000, which I'm lending to you, but 5,500. Because right now, I can earn $500 every year on that 5,000. So I am not making any additional profit on your head. All I need, okay, is to be in the same position that I will be had the money remained where it was. So the $500 in that case will be an opportunity cost. And this is why you told where an alternative course of action is given up. The financial benefits lost are known as opportunity costs. So they are the lost contribution from the best use of the alternative foregone. In the example, the current example, which we are using with you and your friend, the alternative course of action, well, you're thinking about lending the money to your friend, so you're going to give up the $500 you are earning right now, and you will expect, therefore, to at least get that $500, back. It's like that. I mean, we tend to think like that. I mean, if you look at the same example I just used, and you had to loan that money, clearly, you're not going to forget about the $500 interest that you're getting right now. You will expect your friend to pay you the $5,000 plus the $500 back. You see? So opportunity cost, now we will see this in a short example 1A. And in a while, we look at a more detailed example, question 2. Question 2 is a more detailed one. We wouldn't look at that as yet. But let's take a look at question 1A. Okay. Now, question 1A, okay, although it does include the concept of opportunity cost, okay, it really could have been reasoned out without necessarily thinking about opportunity cost in its true sense. Let's take a look at the example and you'll see what I mean. In other words, it's just relevant. Okay, it's a relevant course. So in the exam, see, look at this here. Look at these questions. You would just ask, is the course relevant? Is the course relevant? And so on and so forth. And as we went through, we saw, for example, one was a committed course, so it's not relevant. This is an additional course and incremental, so it is relevant. But we didn't need to actually use the terms. It's just that the terms are specifically applied in certain situations. All you need to do to figure out whether a course is relevant or not is to consider whether the three conditions are there. Now, it may be an opportunity course you're looking at. It may be an incremental. It may be, okay, some future course, and it may be relevant. But as long as you can figure out it's relevant, okay, you're good. Now, I'm not saying you don't need to know the specific meaning of the terms, because of course the examiner can ask you and can expect you to relate it to a scenario, which we haven't done as yet, related to scenarios. But let's take a look at this. A new project requires the use of an existing machine that would otherwise be sold. So this company is apparently considered a new project, and the new project will need the use of a machinery, an existing machinery. But what you've been told is that if the project is not to be undertaken, the machine would be sold. Okay. Note that again. If the project, okay, is not to be undertaken, the machine will be sold. Which means if the project is to be undertaken, the machine will not be sold. See that? Which means the decision to undertake the project will affect what we do with the machine. And if there are any costs that go along with that, then they will be relevant also. Let's see. Information concerning the machine is as follows. The original purchase cost of the machine was $20,000. The current net book value is 5. The estimated current sales value is 4. What is the relevant cost, if any, if using the machine in the project? Right. Now consider this. What we will see shortly on the handout, we looked at certain types of costs which are relevant. Shortly on the handouts, we look at certain type of costs which are non-relevant. Now, but even without looking at those costs which are non-relevant, and they may be referred to in different ways, again, to make it easier to understand. For a cost to be non-relevant, it simply must not have the three qualities. For a cost to be relevant, it must have the three qualities. Now, even if one of the quality is missing, it will be non-relevant, because remember what we've been saying all the while. The three qualities must be present for a cost to be relevant, which means if one of them is not present, okay, then it's usually non-relevant. Now let's take a look. Take a look at those three values given. Before we look at the answer, although the answer is right there. The original purchase price of this machine is a sunk cost. Whatever you decide to do now, in other words, whether the machine is to be used on the project, let me move this out of the way so we can just focus on the talk about this for a bit. Right. The original purchase price of the machine is not relevant. Whatever the company decides to do, i.e., use the machine, this existing machine, on the new project, or sell the machine, the original purchase price was incurred in the past. That's a sunk cost. Secondly, the net book value. Now this is where, okay, some people may have issues. Let's say your company. Let's assume we've got the management accountant who believes in relevant costing and decision making, and we've got the financial accountant who only relies on historical costs because he prepares financial statements, and of course financial statements are normally based on historic costs. Of course, financial statements are produced for the external users. Management accounting, though, is more internal. It's for management. It's to make decisions. Right. So we've got a situation here where the financial accountant may be at loggerheads with the management accountant in this type of decision, because the financial accountant thinks historic and the management accountant thinks relevant. Take a look at it. Let's go back to the figures. The current net book value is 5,000. Of course, net book value is the original cost less depreciation to date. And the book value right now is 5. The current sales value is 4. Now, just to make our point clear, I'm just deviating a little bit from the actual answer. The financial accountant may have issues with that machine being sold for 4, because he would think to himself, and certainly make his point clear, that the net book value is 5. So if we were to sell this for 4, we're going to make a loss on disposal of 1,000. Of course, from a financial accountant point of view, okay, he's right. There will be a loss on disposal. But that's from a financial accountant viewpoint. From a management accountant, i.e. decision-making point of view, neither the 20 nor the 5 is relevant. The only thing relevant there is the 4. Now let's see why. The $20,000, as I said a few minutes ago, is a sunk cost. Whatever you decide to do today can't bring back that. In order to arrive at the 5,000, depreciation of 15,000 would have been charged to date. Depreciation, however, is a non-cash item and is therefore not relevant. So we've got the original purchase price, which is not relevant. It's sunk because it was incurred before. It's not a future cost or anything like that. The 5,000 is not relevant simply because in arriving at the 5,000, 15,000 depreciation was charged, and depreciation is a non-cash item, so it's clearly not relevant. So both the 20 and the 5 are not relevant because, of course, the depreciation charge in arriving at the 5, as I keep saying, is not relevant. The only thing of relevance there is the 4. Let's consider. If the project goes ahead and the existing machine is used, the company will not get the $4,000 from selling the machine. If, on the other hand, the project does not go ahead and the machine is therefore sold, the company will get back the $4,000. So the only thing which is relevant there, okay, is the $4,000. Let's take a look and see what the answer says about that. Notice the question is, what is the relevant cost, if any, using the machine in future? Remember, the original purchase price is sunk, so it's not relevant. The NBV is a combination of the purchase price, sunk, and depreciation, not a cash flow, so clearly that's not relevant. See, you've got to think about this thing carefully and reason it out. Although, by the time you've gone through this, you would have we would have identified several times, okay, when costs are relevant or not. So it will not be difficult, as long as you go through your handout and the recording and whatnot. By undertaking the project, we miss out the opportunity of selling the asset and thus have an opportunity cost of 4. Now it's been broken down like this, but really, you can see why, based on the explanation I gave you, the 4,000 is relevant. See, if you had to answer this in narrative format, okay, you will say exactly what was said about the first two, and then you will say you can give your reason for the 4,000 the same way I gave it to you. That is, the $4,000 is an opportunity cost. If the project goes ahead, the company will be unable to make the $4,000, and therefore this has to be seen as a cost of the project. If, on the other hand, the company does not go ahead with the project, the asset would be sold and 4,000 will be received. So clearly it is relevant. It's the same type of example really that I used a few minutes ago with you and your friend, where if you've got to lend him the $5,000, you will not be able to leave it in your account and earn $500. So the $500, therefore, which is an opportunity cost of that decision, okay, if you lend it to him, you're not going to earn the 5. If you leave it there, you will earn the 5. The 5 is relevant, therefore. But because it relates to the best alternative foregone scenario, it will be described as an opportunity cost. But you see, it still has the qualities of relevance. It's simply because of that type of situation, alternative foregone, where you've given up something, it is considered to be an opportunity cost, just like this here. Okay. Now we wouldn't look at question 2 as yet. It's a little bit more complex. Let's get used to a few more things first. Right, so non-relevant cost. Now again, it's easy to pick this up. You're not going to see the 3 qualities. The 3 qualities must be there for it to be relevant. If even one is missing, it's not relevant. Let's see. Costs which are not relevant to a decision are known as non-relevant costs and include sunk costs, committed costs, non-cash flow costs, general fixed overheads, and net book values. Sunk costs, we've met this quite a few times in the past. Pun on the word past there. Sunk costs are past costs or historical costs which are not directly relevant in decision making. For example, development costs or market research costs, If, for example, another example, if a company is contemplating a capital investment decision, let's say to expand or to buy a new building, to acquire a new factory, or maybe to take over a company, an acquisition decision. The cost of the acquisition will be $10 million. Now, clearly that is relevant to the decision, because if they decide to, remember I said will be, it hasn't been paid as yet. So if the company decides to go ahead with the acquisition, they're going to have to pay $10 million. If the company decides not to go ahead with the acquisition, they will not pay the $10 million, obviously. But let's assume that the company has done its due diligence on the acquiree, meaning the company it intends to buy, and it's done its market research, different things to decide whether it's a good buy. And all those costs which were incurred in order to do the due diligence and the research and whatnot came up to be $100,000. Now that's not a relevant cost of the decision. It's whether the company decides to go ahead with the acquisition or not go ahead with the acquisition. The fees incurred in order to do the research have already been spent. In other words, they are sunk. Okay, non-relevant. Committed costs. Now this is a good example. Okay. Yeah. So committed course. Now, as I was saying, this one is a little bit tricky. Let me use an example of this. You know, we actually did meet an example in the scenario just now, with the 1 month notice that must be given. But let me use a more straightforward one. Again, to show you why the three conditions must be present for a course to be relevant. Let's assume that um, the company for which you work have leased a building, and it's a 2-year lease period. In other words, it's a contract which has been taken out and signed, okay, for a lease arrangement, which says that your company is going to lease this building for a period of 2 years, and maybe at the end of 2 years it might then be renewed. The lease rent will be $5,000 a month to be paid at the end of each month. After 1 year has expired, your company, okay, has decided that the reason for which they initially took out the lease and therefore rented the building, that reason is no longer applicable. It's no longer okay there then. So maybe the building was leased in order to use as an office. But maybe after a year, your company has decided to relocate. And the office space, which is subject or which is the subject of the lease rent, is no longer needed. The question is the remaining lease rent relevant? Now, the answer is no, it's not relevant. It's a non-relevant course. Now, a student may say to himself or herself, of course, it must be relevant because they haven't paid the $5,000 for the next year, each month as yet. 1 year has gone, they paid $5,000 at the end of each month, $60,000 in total. 1 year has to go, but the rent will be paid, and therefore it's a future cash flow, and is therefore, okay, relevant. But the answer is no, it's not relevant. Let's look at the decision. The decision is, okay, this. If your company was to leave the existing location and go to a new location, will they save the $5,000 a month for the next year? If the answer is yes, then certainly it's relevant. If the answer is no, it's not relevant. The answer is no. Why? Because there was a contractual arrangement signed prior to the 2-year period which says that your company must lease the asset for 2 years. Although the rent is still to be paid on a monthly basis for the next year, this is an example of a commitment and therefore gives rise to a committed course, which is normally a course as a result of a past contractual arrangement. So if you were to apply the qualities of a relevant course, you will see that they all do not apply here. 1, is there a future cash flow? Yes, because you haven't paid the $5,000 each month as yet. So it's passed that test. But 2, so it's future and it's a cash flow. But so that's like 2 there. So let's look at the third one. Will the decision be affected? Will the cost be affected by the decision? Remember, that is one of the conditions as well. And the answer is no. That's why, again, the 3 tests must be satisfied. Whether the company decides to leave that location or not, since they've already contracted to lease that building for the next year as well, they need to continue paying the $5,000 a month. They cannot change that. The decision to go elsewhere, or said another way, If your company decides to relocate, they're going to have to pay the $5,000. If your company decides to continue using the building, they're going to have to pay the $5,000. So it doesn't change because that decision is a past decision. It was made at the start of last year, you see. And that's an example of a committed course, you see. Usually you would see it applying to contracts, like lease contracts, that sort of thing, in questions. Non-cash flow costs are costs which do not involve the flow of cash. For example, depreciation and notional costs. A notional cost is a cost that will not result in an outflow of cash, either now or in future. For example, sometimes the head office of an organization may charge a notional rent to its branches. This cost will only appear in the accounts of the organization, but will not be a real cash expenditure. We can use another example as well. Let's assume that in a company, there's a central photocopying department, and let's say there are 10 offices in the company. Now, all the offices, when photocopies are required, and anything related to that as well, scanned copies, faxes, anything like that, they need to go to this central office. So the central office is a internal service related department meant to serve the 10 offices which utilize its service. However, management needs to let the different departments know that there's a cost attached to using the central services of the photocopying department. So what management may do now, of course, each of the departments have operating costs. Maybe each of the departments is treated as a cost center. You may remember from your earlier studies in level 1, a cost center is an example of what we call a responsibility accounting center. And the manager of a cost center is judged based on his ability to keep costs, controlled then. So maybe each of the offices is a cost center, and they incur operating costs. The different costs involved in the each office. But in order to make each office aware of the fact that there is a cost of using the photocopying department, of course the head office, well, the main office, every time a photocopy is done, of course a slip of paper may be filled out or some record maintained, and that would be used as the basis of charging a cost to the relevant user department. Now that is an example of a notional cost. It does not actually give rise to cash flow, meaning it's not as though each of the offices literally must pay for it. It is simply being charged to the offices to let them aware that there is a cost, okay, of using the photocopying department, but they are not actually paying for the course, okay. So a notional course is not a real cash flow as such, okay. It's simply applied for different reasons. One, it may be applied, as in the example I use here, to let the departments know, the user departments, that there is actually a cost, okay, to head office or to the company of this service being provided. In the case of the example used here on the handout, a company may have 2 branches. One that it owns the location, the other one that it rents. And let's assume that both branches are located in the same area, okay. But one of them, as I said, one of the buildings, okay, is rented, the other one is owned. Both buildings are almost identical size and whatnot, except, as I keep saying, one is rented and one is owned. The one which is rented incurs a rental charge of $5,000 a month. The one which is owned, of course, does not incur a rental charge because it's owned. Both departments are treated as cost centers, both offices then, cost centers, meaning the manager is judged based on his ability to keep costs down. Now, it might seem a bit unfair that the manager, okay, of the office which is owned does not receive a rental cost on his monthly cost statement, whereas the one, okay, which is in the office, which is rented, does, have a cost attached to it. After all, it's not the manager's decision as to whether the office was owned or rented. He's just the manager, and he's assessed based on his ability to control costs. So what the organization may do in order to make the results a bit more comparable, and also to let the manager of the office which is owned, let him know that, look here, although we own the office, it's not as though it's free. Because had we had to rent this office, there would have been a cost of $5,000 a month. So what they would do, therefore, is to impute a cost in the statement as well, the costing statement, which is a notional cost, because it's not actually been paid, okay, but it is being included for purposes of comparability and maybe even for costing purposes, okay, because if generally offices located in those areas are rented, okay, then obviously to make it comparable, notional rent will be included as well. General overheads are not usually relevant. I explained this thing to you about overheads. However, some fixed overheads would be relevant to a decision. For example, step fixed costs may be relevant if fixed costs increase as a direct result of a decision undertaken. You may recall a step fixed cost, okay, is one that displays the following pattern. Let's assume that a company is currently producing, okay, units, and there's a supervisor in charge of production right now. Now that supervisor is able to supervise production of up to 10,000 units a month. So which means from 1 unit to 10,000 units, the supervisor's salary is indeed a fixed cost. So if management is trying to decide whether they ought to produce 4,000 units or 10,000 units, the supervisor's salary is not a relevant cost because it will be paid anyhow. But the supervisor can only supervise up to the production of 10,000 units. If management has decided to increase production to 15,000 units because there is obviously a demand for additional units, then they're going to have to hire another supervisor. So the decision is, should we be in management, should we increase output by 5,000 units or should we not increase output by 5,000 units? What are the costs relevant to that decision? Since a new supervisor will have to be hired, then that cost will be relevant. Now, that's an example of a step fixed cost. The reason why, you may remember from your level 1 studies, the total supervision cost is fixed up to a certain level, up to 10,000 units. You may visualize this pattern in your mind. So it's as though there's a horizontal line, okay? Cost is represented on the y-axis, units represented on the x-axis. And you imagine, visualizing a horizontal line moving to the right. And that cost is the supervisor's salary right now. Upon reaching 10,000 units though, okay, if management wishes to produce more, the cost would immediately go up, which would mean the total supervision cost will suddenly go up, made up of the existing supervision cost plus the new supervisor. And clearly that is relevant because if management has to decide to produce more units, they will need to hire an additional supervisor. This is why I told you. Specific fixed overheads are relevant. We use an example of that. We spoke about that in the past. Net book values are not relevant because, like depreciation, they are determined by accounting conventions rather than by future cash flows. This is the one where I told you the financial accountant may have issues. And, there's a good reason why he may have issues with this, because remember, the loss on disposal is a financial accounting item shown in the profit and loss statement. Similarly, the gain on disposal is a profit and loss item shown in the statement as a positive figure, a gain. So clearly the financial accountant will have issues with that. But the management accountant would say it's just not relevant. Past purchase costs sunk, depreciation non-cash, it's not relevant. You see? So, of course, how the way in which we reconcile that is because financial accountant will prepare his financial accounts. Management accountant will prepare his management accounts. The only problem is a loss on disposal will be shown as a loss and a gain will be shown as a gain in the financial statements. Yeah. So saying that each would prepare their own accounts is okay, except that whatever one does will affect the other, and that's where there may be certain issues. You see. Question is therefore which one should be done? Well, strictly speaking, the relevant costing approach should be used in making the decision because we are looking at cash flows, which is why, and this is how it can be, dealt with. Remember, these days, well, not just these days, for a while now, companies meeting certain criteria must, in addition to preparing financial statements, which include a statement of financial position, a balance sheet, and a statement of profit or loss and other comprehensive income, a profit and loss statement, must also include a statement of cash flows to supplement the two others. And cash flows, of course, only include cash flow items. A loss on disposal will not be included there because it's a non-cash item, you see. But we don't need to go that far, really. Okay, so we've got a little summary of the types of relevant costs and types of non-relevant costs. Future cash flows, sunk, avoidable, committed, opportunity. They're not opposite. I mean, it's just that, it's not as though the opposite of, well, maybe the opposite of future is sunk, but still don't think about them like that. It's just that on one hand, the left hand side, I have relevant, on the right hand side, non-relevant. Right. Now, let's just stop for a minute and consider what has been done so far. What we have looked at so far, through the use of some simple examples as well, we've looked at the basics of relevant costing. We've looked at the conditions that must be there for a cost to be relevant. And if they're not there, even one of them, the cost will be non-relevant. And we've looked at a few simple illustrations to bring that out. But we need to go a bit further. Because remember I told you that there are certain specific decision situations that you need to know about, which is what the examiner will ask you. And in working out each of those decisions, you may be called upon to determine the relevant costs of typical inputs such as materials, labor, overheads, and whatnot. What that means is this. There are certain specific rules of relevance that must be applied to the different cost elements to figure out whether they are relevant or not. Let me use an example. Let's take, for example, a material cost. Now, one of the decisions that you need to be able to deal with, which we will be looking at on Saturday, okay, is, let's say, a special order decision. Now, what a special order decision, okay, means is this. Again, we'll be looking at that on Saturday. Right now, you produce and sell a certain product, but you've got some spare capacity, meaning that maybe you can produce and sell up to 100,000 units a month, but right now you're only selling 60,000 units a month. A customer comes to you and he says, look, um, I would like you to do a special order for me of 20,000 units. Same type of units you make right now, but he wants it to be treated separately. Or he may come to you and says, look, I know right now you've got a bit of spare. So with your existing spare capacity, can you do a special job for me? Now, the special job may not be exactly the same units that you produce right now. Of course, it could be, as in the first scenario I just used, but it may also be a separate job, okay, which can utilize your existing resources. So what you are trying to decide upon is what should be the cost and therefore the selling price of the special job. Now, that special job may call for materials which you are using right now. And if there are any materials, and this is just to give you an example as to what we mean by relevant cost of material, which we look at in more detail right now in a few minutes. Let's assume that right now you use a certain type of material, okay? And this material is, you've got it in your stores department, but it is being continuously used to produce the units that you are producing right now. So it's not as though it's just sitting there doing nothing. It was bought and it is used in production right now. Every time you use some, you have to replace it and buy some more because it is used in your normal production right now. This special order would also need to use some of those materials. Now, if you need to take out some of the materials from your stores department and put it to the special order, clearly you're going to have to replace the materials because remember the materials are continuously used in doing what you do right now. So in that case, the relevant cost of the materials to be charged to the special order will be the replacement cost of the materials. Because literally what we're saying is, since the materials are always used in the production of the units that we currently produce and sell, if these materials have to be diverted towards that special order, we're going to have to replace the materials to continue using them in our existing mode. So in that case, the relevant cost of the materials to the special job will be the replacement cost of the materials. However, let's assume that apart from those materials that we just spoke about, the special order needs another type of material as well. Call that material X. The company currently has material X in store, but material X is not used right now in doing what they currently do. Maybe it represents the surplus of material which was bought in the past to do some other job, and it's just sitting there in stores department. We do not intend to replace it because it is not regularly used in production. The only thing that can be done with that material is to sell it as scrap, and let's say it's 1,000 kilograms there, and that is what is needed on the new job, the special order. And the only thing which can be done is to sell that material as scrap for $2 a kilogram. Now, in that case, the relevant cost of the material to be charged to the special order should be $2,000. The 1,000 kilograms at $2 a kilogram, which is the scrap value. Because if the company, the way we will analyze is still using our three conditions, If the project is to be undertaken, if the special order is to be undertaken, okay, the company would be unable to make the $2,000. Whereas if the project, okay, is not to be undertaken, the company will be able to sell it as scrap for $2,000, and therefore the relevant cost of the material will be 2,000. See, determining the relevant cost of materials is a bit tricky because material being what it is, there are variations. And you need to know how to evaluate those variations. It's one of the areas in relevant costing, okay, which really could take a lot out of a student unless the student knows the rules of relevance that apply to materials. When I say take a lot, and the student really has to think it through. It's not as straightforward as say fixed course. It's even not as straightforward as labor cost, determining the relevant cost of labor. Although labor has its rules as well, but even that there aren't as many variations as with materials. So when looking at a decision situation which involves materials, the only way that you can accurately work out the relevant cost of the materials is if you know the rules of relevance related to materials, and this is what we are going to look at now. So determining the relevant cost. Now, in order to get this across, what you'll find is as we go through the different types of costs, I have to use a decision situation to refer to. And the easiest decision situation to use for you to understand is this same special order decision, which is an example of a decision situation you need to know about. As I said, you only need to know about 4 or 5 main decision situations for your exam, and this is one of them, a special order decision. So, relevant cost of materials. If used and replaced regularly, this is their current replacement cost. And this, as you will see shortly, and as I just mentioned, will be the relevant cost. But what if we already have them in stock and won't use them regularly? As I said, maybe it was bought a while ago with 1,000 kilograms, but we don't use them regularly. Well then, we can either sell them or use them on another project. So here, the relevant cost of using them is the higher of their current resale value, the alternative use value. So also, if the materials have no resale value and no other possible use, the relevant cost is nil. Now, remember I said a minute or two ago that determining the relevant cost of materials really is the most complex of them all, meaning in relation to the other types of costs like labor and so forth, because there are so many variations. And also, this is another example of the confusion which may be caused by the fact that students naturally tend to think historic rather than relevant. Let me use an example. Let's assume that you've got some old pieces of metal sitting at the back of your house, and it's been there for a while. Now, you can't sell the metal and make any money at all. It's just there, okay? Someone, okay, maybe a friend of yours or not a friend, maybe somebody passing on the road, they observe the old pieces of metal sitting there at the side of the back of your house somewhere. And they say, look, can I have those pieces of metal? Now, when they say can I have them, they mean literally, can you give them for free? Okay. But the way you interpret it is this. You think to yourself, well, let me see now. When I bought those pieces of metal 5 years ago, for each one I paid $50. And there are about 10 of them sitting there. So that's $500. So you're telling the person now, you say, look, I paid $500 for those. But, I really don't have any use. They've just been sitting there for a while and whatnot. So I'm willing to let you have them for $100 only. Now, remember, you cannot do anything else. The assumption is you cannot do anything else with the metal. You can't even sell them as scrap because no one wants to buy them. No one has a need for them anyway. Okay, there's not a market for them, not even a scrap market for them. But this person wants to take them off your hands, okay, and you are willing to charge them $100. Guess what? Applying the rules of relevance, you should not charge them anything, because when materials are present in stores, in this case, stores is your backyard, and the materials have absolutely no alternative use, can't even sell them for scrap, and a special order comes along. I said that is the scenario we're using to relate. And that special order so happens has a use for these materials which you have sitting in stores which you cannot even sell back for scrap. Quite literally, the relevant cost of those materials to be charged to the job should be zero. Because if you take the materials and use them on the project, or if you don't take the materials and use them on the project, you're not going to lose out anything, neither are you going to gain anything. And that's why the relevant cost should be zero. And that's why it's difficult, often difficult, for students to think relevant. Because most people, including students, of course, would tend to think like this. Well, the same way that you are thinking about when charging the person $100. In fact, we can actually take this one step further, which would further illustrate, okay, why students may not think, in relevant cost mode, but may think in historic. Let's consider again the same example with the pieces of metal sitting at the back of your house, which you bought 5 years ago for $500, but which you cannot sell back in any way, okay? But you've decided to quote $100 for this person who wants to take them off your hands. I told you relevant costing rule says it should be zero. You shouldn't charge this person anything. Just a really special job, material cost for that job should be zero for this type of material. It can go in another direction as well. What if, to get rid of those materials from the back of your house, you had to pay a removal firm $100? But this customer or this person wants to take those materials off your hand. Relevant costing would literally suggest that you should actually pay that $100 to the person, because alternatively you were going to pay that $100 to a removal firm to have it removed. And how that may apply in a special order decision is if the customer, okay, wants you to do the special order for them, and that special order calls for this type of material which you've got in your stores department, the company has in the stores department, and they've got no other use for it whatsoever. And in fact, okay, they were thinking about paying a disposal firm to remove it for them, and it would have charged them, say, $500 to remove it. And that material now is being used on your job on the special order. It comes as though that customer is saving you from paying the $500. And it comes as though, therefore, and this is how relevant costing would look at it, that saving should be applied to the special order. And literally, rather than showing a cost, you will actually show a negative, meaning a savings to the special order, and which would actually reduce the material cost charged to the special order in total. And this again is why students often have problems relating to relevance. But you see, A cost is either relevant or it's not. It can't be halfway in between. It's either relevant or it's not. And in the example I'm using, if you were to apply the rules of relevance, you will see that it is the relevant cost is the savings. If the company has to undertake the contract, they will be saving $500. Because if they had to not undertake the contract, they would have to pay a removal firm to get rid of it and pay them the $500. So the $500 is a cash flow. It's a relevant cost, therefore, in this case, a relevant savings for the customer to be charged to the job. Takes a bit, I guess, in used to. But this is one area of the course where you really need to use, okay, I was going to say common sense, but more than common sense, because you need to apply the rules of relevance on top of the common sense. And remember I said at the start of the lecture, it's as though what you've got to reprogram your brain. Stop thinking historic and think relevant. If you start thinking historic and relevant at the same time, you will always make mistakes. You've got to move from one sphere over to the other. So let's see here. These are the general scenarios that can apply with materials. And again, to bring it out, I'll be using a special order scenario. That is one of the decision situations you need to know about, as I've been saying. So customer comes, customer wants you to do a job for them. The job calls for 500 kilograms of a certain type of material. If the material is not in stock, clearly the only relevant cost would be the purchase cost. Because if the 500 kilograms are not in stores department right now, and that is what is needed for the job, call it type A, you need to buy it. So the only relevant cost there could be the replacement cost. If it now, when assessing a situation, for example, purposes and doing a question and it involves materials, exactly what you see in here, okay, in the diagram is how you may need to think things through. First thing is, of course, the question would give you a description of which of these apply. You just need to know about if one or the other applies, what am I going to do? As long as in that question you see the material required is not in stock, it's easy. Because if it's not in stock, the only way you're going to get it is to buy it, and therefore the cost to be charged to the job, the only relevant cost could be the purchase cost of the material, which here we see it as the current replacement cost. If, however, the type of material to be charged to the job is in stock, now there's where you got a few more variations to think about. So really, you much prefer to see this one in the exam in stock, not in stock, sorry, than in stock. So now the materials are in stock. The 500 kilograms required for this job, they are in stock. But let's look at the different scenarios which may apply to them. Firstly, are they used regularly? Now, we used this example before when I was trying to explain it earlier, a few minutes back. Since if the 500 kilograms to be used on the special order are used regularly to do what the company normally does, it means taking the 500 kilograms and using them on the special order would cause them to be replaced, because remember, they are regularly used. So it's very easy. As long as the materials are used, as long as the materials which are required for the contract are regularly used by the company and doing what it normally does, the relevant cost will be the replacement cost, just as this one over here, because it would have to be replaced if used on the other job. If, however, there is no other use for the material, we don't use it currently in our production, and it won't be replaced, then the only relevant cost to be charged to the job would be any resale value, like a scrap value. Yes. So now the description is the job needs 500 kilograms of material. The material are sitting in stores department, and the examiner may phrase it like this. The materials represent materials left over from a previous job undertaken, and the materials are not used in the current production. The material can only be sold for scrap at $2 a kilogram, and that is what you will use as the relevant cost then, the current resale value. By the way, using the same type of analysis here, no other use won't be replaced. If the materials that we are talking about have no scrap value whatsoever, then the relevant cost will be zero. Again, a cost is either relevant or not relevant. It can be part of one and part of the other. It's either the relevant rule applies or it does not apply. So similarly, using this same rule here, no other use will not be replaced except that it has no current scrap value. The relevant cost will therefore be zero to charge to the job. This last one though, let's assume that the 500 kilograms to be used on the special job, these 500 kilograms are used right now in production. We've got some in stock, but they are scarce. In other words, we've got about 600 kilograms in stock. Remember, they are regularly used in production. But the supplier has said, look, when your materials, your current stock runs out, you're not going to be able to get any more for a little while. There is a shortage, scarce. Right. Now, in that case, any of those materials which are utilized on the special job cannot be replaced because we can't get any more right now. And there's also another side to it. Since the materials are scarce and in short supply, any material which is diverted from our normal current production to this special job means we cannot also produce a unit or units which would have been produced. So when material is scarce, it cannot be replaced. The total relevant cost of the material includes an opportunity cost plus the normal direct cost of the material. In other words, then, what we would usually pay for the material, as well as what we are losing out on by using the materials on the special order rather than using it on our normal production contribution. The concept there is not difficult, really. I mean, it's like this. You've got some materials right now, okay, and maybe you are a contractor and you've got some materials there which you use on your normal jobs. Maybe you build apartments or construct different types of things for customers, and these jobs require the use of the materials you've got. But right now the stock of materials, okay, it's the material type is scarce. A customer comes along and the customer wants you to do a special job for them. The materials right now, if you could have replaced them, would have cost you $10 call it a unit of material. But if you've got to use the scarce material in this customer's job, it means that it cannot be used on your normal production. So you're going to be losing out on contribution from your normal production. So what you'll tell the customer, say, look here, you're going to have to pay a premium for the material part of the job. The customer says, how? Says, because right now these materials are scarce, and every material that I take, every unit of material and use on your job It means I cannot use it on my doing what I normally do, and it means I am losing out some money. We will call that losing out contribution. And you're going to have to pay me something extra then. And the extra would be calculated as the lost contribution from not being able to use the material in the next best profitable way. In other words, the lost contribution is an opportunity cost. Remember, an opportunity cost is the best alternative foregone. Now let's just take a simple look at this example, and that'll be it for tonight. Okay, we will continue with this relevant costing discussion on Saturday. You see how important it is and how detailed a topic it is, but it's very, very important because many other things in the course are also based on this. Not everything, of course, but many other things. Let's take a look at this example. Material A, we are looking at a special order scenario here again. And you've been given a description of two types of material, A and B. Quantity needed for a contract, 400 kilograms of A, 200 kilograms of B. Quantity currently held in stock, 200 kilograms of A, 100 kilograms of B. So right now for A, 400 is needed for the contract, but we've only got 200 in stock. Original cost of the inventory, 10 and 20. Current purchase price, 15 and 22. Current resale price, 12 and 15. You've been given some descriptions. A is regularly used in the business. B is no longer used and has no alternative use in the business. But notice for B, the fact that you've given a resale, meaning that assumes that you can sell it for scrap then. The relevant cost of the material for the job will be as follows. Notice the job needs 400A, 200B. We got 200A in stock, 100B in stock. A is regularly used in the business. Now remember what you saw up here and what I told you. If it is in stock and it's used regularly, quite simple, the relevant cost would be the replacement cost. So let's see. The relevant cost of material is A, regularly used, replace. Remember, it needs 4. So the relevant cost would be 400 at 15, which is the current replacement cost, the purchase cost. Of course, what that would mean is this. It's as though you'll be taking out 2 from your stores right now. And of course, in taking out 2, you have to replace it because remember, it's regularly used. So that's 200 at 15. And the only way you can acquire the other 200 is to buy it. So it comes as though it will be 200 at 15 plus 200 at 15. The 200 at 200 at 15, what you've got in stock right now, which has to be replaced as a result of the decision. The additional 200, which you need to buy. So of course we can just call it 400 at 15. Remember I told you these two would be the same. B, we need 200, but 100 is in stock. Now this is a bit of a strange scenario really. Remember B is not used in any other way. The only proceeds that the company can earn right now from B is if it's sold as scrap at $15 a kilogram. Thing is though, the job needs 200. The question is, where is the other 100 going to come from? Well, the only logical place is to buy it. So now you've got a situation where the relevant cost for B is actually made up of 2 parts. Let's see. Material B, 100 kilograms in stock. And it could have been sold if not used in the contract, meaning sold as scrap. So for that 100, we're going to charge the relevant cost as being the scrap value, which is $15, $1,500 therefore in total. But the other 100 is needed as well. It comes as though tools being applied here are as follows. This one, no other use, current resale, which is scrap, and this one, because after using up the 100, the other 100 is not in stock, so we're going to have to buy it. Other 100 have to be purchased at 22, which is the current purchase price, 2200. The total relevant cost is therefore 15 plus 22, which is 37. So well, therefore, 37. Please note that the original course is a sunk course, therefore irrelevant. See this here? Where is it? The original course. When dealing with materials, the original course is really a historic course, and historic courses are not relevant. If you were to also call it a sunk cost, that's okay, because it does represent a cost incurred in the past. But usually sunk cost, the term, is usually reserved for more large-scale expenditure, like past research expenditure, past uh, um, capital expenditure incurred, and so forth, like the past purchase price of the asset we saw in an earlier example. Historic cost is normally applied as a replacement for sunk cost when dealing with past purchase costs of materials. If, however, you were to use the word sunk here as well, as I said, you wouldn't be marked down, but just as well you can use the term historic. Okay, so we stop here for tonight. It's on about 9:35. And what you should do, obviously, before Saturday is to go through everything which has been done so far, in addition to the recording and the illustrations, which again I'll send you. What I'll send for you is I'll send you the handout, this handout, along with the worksheet which we just used, okay, for you to go through, or which we used earlier in tonight's lecture. And of course, as you no doubt realize, it's very important that you do go through this and the recording before Saturday, because we're going to continue with this on Saturday, and it will become a bit more complex. Yes, on Saturday, having finished off a discussion of the different types of costs and how we determine whether it's relevant or not, we will then look at the specific decision situations, special order, make or buy, further processing decisions, things like that. As I said, there are just about 4 or 5 key decisions you need to know how to evaluate. So that's it for tonight. Look forward to meeting with you all on Saturday for the performance management. Remember, I told you on Saturday, before we actually get on, we'll be covering a few little questions on throughput accounting. So please ensure that you do go through your throughput handout for Saturday as well, of course, what we have done so far on this. So that's it for tonight. Good night to all, and we'll meet up again on Saturday.